Welcome to part 2 of our video on auditing accounts receivable. Today I'm going to get into tests of internal controls and substantive tests. So let's get into it. What I've done from our last video is I've summarized all of the controls and I've already written them out here on my document, and then I'm going to talk about the types of tests of internal controls and substantive tests that we might do. Now I'm not going to write them down because what I discovered from making my last video where I did this is that the writing tends to take quite a long period, and you can take notes or look at the transcripts and closed captions of the video. So let's look at the first internal control, which is a process to approve customers to buy on credit. If I'm testing this as an internal control, of course, I want to be sampling. I'm not going to test all of the debtors, but the sorts of things that I would do here is I would select a sample of our debtors, perhaps new ones approved this year, and go back to check the approval documentation. Is there some sort of cover sheet? What did the clients have to provide? Was it bank statements, financial statements? What did we approve? Who approved it? And was that approval within our regular schedule? So normally there'll be some sort of guideline about who can approve and also how much credit people can be granted. So if a company has audited financial statements and they have a turnover of X number of thousands of dollars, then we'll set the amount of credit that that entity will have appropriately. So I need to look at these approvals for credit, make sure that approval has been done. There was an approval process. We've got signatures, we've got documentation, and those signatures and documentation seem to follow the company policies. So we do expect that there is a policy or a procedure or a document somewhere that says how much credit people can apply for and who can approve those. Now the second internal control is that when a sale is made, the system records a journal entry based on whether the sale is a credit sale or a cash sale. So when I'm auditing sales and I'm looking at those control processes in the sales system, I want to make sure that I investigate, well, what is the mechanism to make sure that the journal entry does go to accounts receivable and not to cash. I might need to test some of those, select a sample of sales made on credit from the sales orders, and then see if I can trace through to those journal entries to make sure it's debiting accounts receivable appropriately. Now, if the company has a lot of accounts receivable accounts or sub-accounts for customers, we need to make sure that it's also going to the correct sub-account. So what sort of programming goes into the system in our internal controls, in our point of sale system to make sure that that happens? Now the next one was depositing cash or checks. And I said that, there should be some sort of register of the monies or checks received at reception, as there should be a different person that takes that to the bank. And then those two separate documents should go to accounting. So we want to make sure that that reconciliation was done. So the accountants are receiving the check or the deposits or the monies received register and the bank deposits. We also want to make sure that those are being filled out by different people. So usually there's some sort of signature or initials on each of those two documents. Make sure that they're different people within the firm. You might need a staff list or a HR list for that. And then check that they've been reconciled to make sure that for every money that was received, a deposit was received. So we need to make sure that that reconciliation is done. That's usually part of the process, of course, for recording payments for accounts receivable. So usually when we have our accounts receivable, we record monies received by check, by cash, but also by direct deposit. So through the bank statement, we should be able to see any direct deposits that come through. And then the accountant has prepared journal entries. Now, normally they can't just prepare journal entries and do whatever. There's normally a process to approve the posting of those journal entries. So that means somebody schedules all the journal entries, then somebody else looks at the journal entries that have been prepared, compares them to the supporting documentation, which could be the bank statement, proof from the bank deposit, or some other format to prove that that transaction really did occur. We've received the money, and then approves those transactions. Usually there's a two-stage process there in a large firm. In a smaller firm, then you might want the owner to check or to do this particular part, and we'll check that the owner is doing that. Then the last one is the reporting of overdue debtors by management. Now, in the reporting of overdue debtors, we hope that in most larger firms that we would be auditing or that would need an audit, that they would have some sort of monthly report about what is overdue. We want to make sure that that report exists and also that that report is being reviewed by somebody. So it's not enough for the report simply to be just made. It needs to be reviewed and checked by somebody so that then we know that there is an oversight process. It's not just somebody doing something on their own. Now, one thing that I forgot to include, but I'm going to add here, is an approval process to write off bad debts. Now, the reason that we need to have that is to stop somebody from saying to a friend, hey, buy some goods off credit from the company I work for and then don't pay for them and I'll write off your accounts receivable as a bad debt. So we need to make sure that there is an approval process for any bad debts that have been written off. So you'll go through your bad debt expense journal entries, find those, trace or vouch back, sorry, I should say the correct term here, vouch back to the supporting documentation and make sure the financial controller or the CFO has signed off on that write-off of that bad debt expense, because that should definitely be a control. Okay, so now let's get into the substantive testing. And when it comes to substantive testing, of course, we always want to start by making sure that we identify all of the different assertions. So we have the existence assertion we need to worry about, the accuracy, valuation, and allocation assertion, the completeness assertion, and the rights and obligations assertion. Okay, so for existence, we need to prove that these accounts receivable actually do exist. So how could we prove that these customers are real customers? Well, number one, we could look for real sales. So we could select a sample of accounts receivable and send a debtor's confirmation. Now, a debtor's confirmation is basically a letter that the auditor sends to the debtor and says, hey, are you a real debtor? Do you owe us this amount of money? So it's a really great test for existence. It'll also help you a little bit with testing valuation, but it's not a great test. And it's not a great test for a very specific reason. If you owed $50,000, I'm going to just scroll down here a bit. So let's say that the amount owed was $50,000 by the customer, okay? But according to the journal entries and the records, it says that you owe $40,000. So if you got a letter that said, do you owe XYZ company $40,000? You'd go, yes, all right, I don't have to pay this extra $10,000, they've forgotten about it or they've lost a transaction, okay? So when accounts receivable is understated, a debtor's confirmation doesn't help us. But what if the situation was reversed? What if the journal entry said you owed $60,000? You received that letter in the mail or the email, you'd be ringing them up on the phone going, excuse me, it says $50,000, but actually I owe $60,000. So if you've overstated accounts receivable, it's a really great test. So when it comes to doing debtors confirmations, they're a really great test for overstatement only. Okay, they're not a really great test for understatement. So you could send out one of these confirmations and you could send it by email or you could send it by physical post, but it's something that's falling out of favor because people just don't reply. You send these to customers and they just don't reply. So another way to check the existence is to gather information from your sales. So use testing from sales, proof that transactions were real and did occur. All right, so if most of the company's sales are on credit, then when you've gathered evidence to prove that the sale is correct, the credit side of the transaction, then you're also gathering information on the debit side. So existence there is pretty reasonable. Now, when it comes to accuracy, valuation, and allocation, we want to make sure that transactions have been recorded at the correct amount, individual journal entries, which you'll do when you're testing sales. So that accuracy part we'll do a lot of when we're testing sales. Valuation is making sure that all of them add up. Okay, so there's usually some sort of recalculation tests that you can do there to look at the journal entries, add all of those journal entries up, make sure it adds to the individual value of the accounts receivable. Now, another way that we can test the valuation of accounts receivable is by looking at a subsequent cash receipt test. And that means, let's say here at the 30th of June, which is our year end, the customer owed 30,000. Okay, and rather than go back and try and prove a whole lot of other things by doing a lot of calculations, let's say I look in August or September. If I can find a payment in the bank transactions for 30,000, that matches back to this transaction over here, I can say, yep, I've got proof that the accounts receivable existed and this is the correct amount. I've tested the valuation assertion. So I can use this subsequent cash receipt test, this is a really important name to learn, to actually check valuation and to check existence as well. Next, we move on to the completeness assertion. And remember, completeness is about understatement. And this is less likely because companies are less likely to understate or not record some of their accounts receivable. So in terms of trying to test any missing accounts receivable, you might also, as part of that subsequent cash receipt test that we did up here, also see if you can identify any cash deposits that are not cash sales or existing accounts receivable. And that might be an accounts receivable that was forgotten to be recorded. When you're testing completeness of sales, if you found sales that were made, goods that went out but no transaction, then that'll also help you here as well. So use sales audit procedures for the completeness assertion. All right, so that's another way that you can test completeness. Completeness is one of the hardest assertions to gather evidence on because you're trying to find things that may not be recorded, but they might not be recorded because they didn't actually happen. So it's a bit like trying to find an invisible pin, whether it may or may not be there. So completeness is sort of a bit like Schrodinger's cat in that way. Now, the last assertion that we have is rights and obligations. Let me just do this in the orange again so it's a little bit clearer to see. With rights and obligations, it's less so obligations and more so rights. Do I have the right to record that accounts receivable as an asset? Now, that right is all going to come down to, was the sale valid? All right, so remember that we have sales and we have the cutoff assertion, which is about making sure that goods were delivered to make sure that we can record the sale appropriately according to our accounting standards. So we need to make sure that for any accounts receivable we owe, those goods were delivered to the customer. All right, so when we're testing the sales cutoff assertion, then that'll also flow through to helping us test the rights and obligations assertion. Now, I realized just then that one of the most important valuation tests that we should also do is an aging of accounts receivable. And an aging of accounts receivable is really just stratifying or breaking down the population of accounts receivable into groups based on 0 to 30 days overdue, 31 to 60, 61 to 90, and 90 plus. All right, so you would have here all of your different accounts receivables, and you'd hopefully have less in the very overdue amount. Now, what is really smart here is if I'm testing general accounts receivable, those tests that I'd done before, well, what I would do is I would select my samples from within 0 to 30 and 31 to 60, all right? Because the transactions that are overdue, I'm going to need to do something a little bit more appropriate to. So those 0 to 60 days, I might do subsequent cash receipts test. I might do recalculations of transactions, mapping it back to my sales. What I'm going to do with the other ones, 60 to 90, 90 plus, is this is where I'm looking for bad debts. All right, so whereas before here I might randomly or haphazardly select samples, what I'm going to do when it comes to accounts receivable in that 61 to 90 and 90 plus is that I'm going to be looking at these as potential bad debt expense. Oh, I can't spell debt. All right, and these ones potentially might need to go into the provision for doubtful debts. DD there is doubtful debts. So I'm going to need to look very carefully, and I wouldn't even sample. What I'm going to do here is I'm going to look at all of the debtors in these particular categories, right? Because it wouldn't be any good if I had 10 potential 90 plus day ones and just look at 2 of them. Sampling isn't going to help us here. So we need to be more specific, be more precise in our sampling, and instead of sampling, looking at all of them, because the risk of material misstatement here is much, much higher, and we need to make sure that we write off any bad debts and make sure that we have the appropriate provisions. Because remember, that's also going to have an impact on going concern when we analyze going concern and we analyze cash flow. If the company has had increasing days in receivables, so if days in receivables is going up and up, then that's going to also affect the cash flow and the going concern of the entity. Now, I did realize that I forgot to include one last assertion, and that's about presentation of the information within the financial statements. So we also, of course, do need to make sure that we're presenting our information in accordance with the Australian Accounting Standard or with IFRS, and that also includes appropriate recognition of provisions for bad debts and also bad debt expense. All right, so there are specific disclosures you need to make about provisions for doubtful debts and bad debt expense. You also need to go back and make sure that if they do have provisions for bad debts, that they're calculating that appropriately. Now, in most regular day-to-day reporting, businesses will do something like 5% of accounts receivable is a provision for doubtful debts. But for our accounting financial reporting, we can't actually just say 5%. Instead, what we have to do is we have to go through individual accounts receivables, mark some as maybe not able to be collected, they will go into the provision, and the ones that we definitely can't collect need to be written off as the bad debt expense. So that means that where you do have bad debt expense, which would be audited sort of at the same time that you'd be auditing accounts receivable, you'd need to do that. So that's all I've got for testing internal controls and substantive tests around accounts receivable. Now, of course, this isn't a fully exhaustive test. If you go into auditnet.org, you can find heaps of other audit procedures, but these are the ones that I like to use and I like to see my students design in terms of their work, and they're used most commonly. If you have suggestions for other tests, please pop them in the comments. I'd love for you to share. So of course, as always, thumbs up if you thought the video was useful. I'd really love it if you subscribe, and please make sure you stay tuned because we've got plenty more in this series on auditing specific accounts. Thanks for watching, and I'll see you next time.